Today, we're going to talk about how to fix credit score fast by building credit. A higher credit score can help you qualify for a mortgage, get a lower interest rate, and get better terms on a loan or a credit card. If you're wondering how to fix your credit and make yourself more appealing to lenders, there are many steps you can take over time to improve and repair your credit. The best time to learn how to fix a credit score is right now, so that when you need a loan or a credit card, your score is already where it should be. Before we can learn how to build credit and improve your credit score, we must first understand the causes of poor credit. A lender may refuse a potential borrower a loan due to a variety of bad credit reasons. A person's bad credit is a record of past failures to make timely payments for bills and loan payments, as well as the likelihood that they will delay or default on future payments. When a potential borrower has a poor credit history, it is difficult for them to obtain loan applications, credit cards, or even rent an apartment. When a person makes late payments or fails to make payments at all, the lender or creditor reports the information to credit bureaus. The information is contained in the individual's credit report, which is used by lenders and other creditors to determine whether or not to extend credit to potential borrowers. A corporate borrower can also have bad credit based on their creditor's payment history. Let's look at the reason for bad credit. 1. Late payments. Payment history accounts for 35% of a person's credit score. If you miss payments for more than a month, the creditor may have reported the information to the credit bureaus. The information is also recorded on your credit report. Your credit score will suffer if you consistently miss payments to lenders, credit card companies, or utility providers. If your bad credit is not repaired, your credit score may be classified as poor or very poor, which may reduce your chances of being approved for a loan. 2. Collection accounts. When creditors are unable to collect payments from a borrower, they can rely on third-party collection agencies to assist them. Before or after charging off their account, most creditors hire or sell the delinquent debt to debt collection agencies. When delinquent accounts are turned over to collections, the information is recorded in the credit report. Creditors will be hesitant to extend credit to a borrower with a history of poor collection unless such information is corrected. 3. Filing for bankruptcy. If a person or company is unable to pay their debts, they may be forced to file for bankruptcy in order to obtain legal protection. Filing for bankruptcy is a drastic event that has the most negative impact on an entity's credit score. When a borrower declares bankruptcy, the information is recorded in the credit report and remains there for 7 years. Due to the complexity of bankruptcy cases, most lenders are hesitant to lend to borrowers who have a history of bankruptcy and court cases pertaining to their financial situation. 4. Charge-offs. If an account has been delinquent for an extended period of time, the creditor will charge off the account. A charge-off indicates that the creditor has given up trying to collect payments from the borrower, and it leaves a negative mark on the credit report. When an account is charged off, the account holder is no longer able to use the account to make purchases. When a charge-off occurs, the borrower still owes the creditor the charge-off balance. The credit score will suffer as a result of the unpaid charge-off. When a credit card account is charged off, the information is reported to credit bureaus. The charge-off information is kept on the credit report for 7 years after the account becomes delinquent. 5. Defaulting on loans. Loan defaults are handled similarly to account charge-offs. If you miss more than one payment and do not pay by the end of the month, your account is marked as delinquent. The lender will report the information to credit bureaus, which will harm the borrower's credit reputation. Prospective lenders will view the borrower as a credit risk who is highly unlikely to repay loans once they have access to the information. The first step in starting to build your credit score from scratch is to use a secured credit card. A secured credit card is backed by a cash deposit that you make up front. The deposit amount is typically the same as your credit limit. The minimum and maximum deposit amounts differ depending on the card. Many credit cards require a $200 minimum deposit. Some companies, such as Advent, Deserve, Patel, and Jasper, now offers no security deposit credit cards. You'll use the card just like any other credit card. You can buy things, make payments on or before the due date, and you will pay interest if you don't pay your balance in full. When you close the account, you will receive your deposit back. Secured credit cards are not intended to be used indefinitely. The goal of a security card is to build your credit enough to qualify for an unsecured credit card, which does not require a deposit and offers better benefits. Select a secured credit card with a low annual fee that reports payments to all 3 credit bureaus, such as Equifax, Experian, and TransUnion. Your credit score is calculated using information from your credit reports. Credit cards that report to all 3 bureaus enables you to build a more complete credit history. To find financial institutions that offer secured cards, search Google for best secured credit cards, and then research secured credit cards that you can sign up for. If you found this video helpful, click on the like button and subscribe to Shaun Academy, an extension for education.